buy something because you're hoping tomorrow morning you're going to wake up, and the price will be higher. The only reason, you need more people coming into it than are leaving, and you can get that, and it will feed on itself for a while, and sometimes for a long while, and sometimes to extraordinary numbers. But in the end, they come to bad endings, and cryptocurrencies will come to bad endings, and along with the fact that there's nothing being produced in the way of value from the asset, that you also have the problem that it draws in a lot of charlatans and that sort of thing who are trying to create various sorts of exchanges or whatever it may be. It's something where people who are of less than stellar character see an opportunity to clip people who are trying to get rich because their neighbor's getting rich buying this stuff that neither one of them understands. It will come to a bad ending. Charlie?
Well, I like cryptocurrencies a lot less than you do. And so, to me, it's just dementia. And I think the people who are professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds and you decide I can't be left out.
To the extent that we're being webcast around the world, I hope some of our stuff doesn't translate very well, actually. Okay, Gary.
Yes, I had a question on the corporate tax rate, and we have a debate in my investment world about where the benefits of that cut fall. And I'd say the consensus is going to the consumer as it gets competed away over time, but perhaps some of it sticks to shareholders. And my question is, do you think over the long run some of the benefit sticks to shareholders? And maybe it's even beyond auto insurance. Maybe it's other businesses you have as well.
Well, what people do generally with that is they take what they want to be the answer for them, and then they hire, or they just attach themselves to some economist that gives them a more complicated way of saying it's all going to be wonderful because it's happened. But the answer is that in the case of our regulated public utilities, the benefits are all supposed to go and will go to the utility customer because we're entitled to a return on equity if we perform well, and we're not entitled to get excess returns because our tax rates change. That so and similarly, if tax rates would go back up, we would expect to get compensated for that. So in that area, and that was $5 or $6 billion for us, but in that area, absolutely goes to the user, the consumer, and it should. Then the question is, with the remainder, does it get competed away or not? And the answer is sometimes it does. Sometimes it gets competed very quickly and substantially. Sometimes it may be slow, and other times it probably won't. The one thing you know is that the change in the corporate tax law was good for shareholders generally and Berkshire shareholders. I mean, and that's what Congress passed, and the intent had to be that if you were going to cut taxes, that shareholders would get a particularly large portion this time, and some of you will agree with that politically, and some of you won't agree with it politically, but you'll all benefit equally. And I think it's human nature, if you're getting a break, to say it's going to work wonderfully for everybody else, and we'll find out whether it will or not. It's very, very, very difficult in economics to measure the impact of single variables. You cannot just do one thing in economics. People kind of learn that in physics and talk about butterflies in China and all that sort of thing. But every question you get in economics, the next or any statement you should say, and then what? The next or any statement you should say, and then what? And when you get into the and then what's, you start favoring people who give an answer to that in political life that happens to usually help you in some way or another, and including your pocketbook. And we've seen that with this, and it's helped the shareholders of Berkshire Hathaway. I would say that some will be competed away, some by local utilities, and some will benefit Berkshire shareholders. Charlie?
I have nothing to add.
Okay. Station 3.
Hi, Mr. Buffett and Mr. Munger. My name is Kevin, and I'm from Shenzhen, China, currently studying finance and philosophy at Boston College. I have a rather broad question. In this more and more globalized world, what do you think our younger generation can do to best leverage our background and experience of both China and US to create values and further benefit two countries' economy and relationship? And what do you see valuable in a person with a multicultural background? Thank you.
Well, I think in answer to the last question, I think it's terrific to have a multicultural background. And if I never was any good at languages, but if I were in college today and in either country, I'd be learning the language of the other country, because I think it'll be a great advantage over time. The first part of the question, I'd like to have that stated again to me. I want to make sure I'm answering your specific aspect on I think it's going to be good for your future, but can we have the microphone on up there again?
So the first part of the question is, what do you think our younger generation can do to best leverage our background of both China and US?
Bilingual. I mean, certainly in terms of, obviously you want to be able to express yourself in both. And the better you can understand, obviously, the culture of another society, obviously that's a benefit. But I think the market system, modified as it may be, both in China and in the United States, the way it really does, there will be an invisible hand to some extent that does work to improve the lot of future generations by the fact that both China and the United States and the rest of the world is improving. I mean, it is much better, in my view, particularly in a nuclear world, but it's much better to have people prospering throughout the world, partly through their own efforts, but partly through their interactions with the rest of the world. And we've made a lot of progress in that respect, particularly since I mean, it was a terrific idea to have the Marshall Plan, instead of behaving like we did after World War I and getting the result that we got. I think we behaved much more intelligently after World War II. So I'm bullish on the future of the United States, but I'm bullish on the future of China and to a significant extent, the rest of the world. People are going to be living better 10, 20, 50 years from now, and I don't think that's something that can be stopped even. Charlie? Absent weapons of mass destruction.
Yeah, well, the multicultural stuff, it wouldn't do you much good to be fluent in both English and Chinese if you were, say, a proctologist in China or a proctologist in Nebraska. So if you're going to use your multicultural background, you've got to work at some interface between the United States and China. And you can raise money in the United States and invest it in China like Li Lu does, or you can be some kind of an importer or a trade specialist. But you got to get near that interface to benefit from bilingual and so on.
But you would bet that the interface will be substantially greater.
Huge.
Yeah.
Huge.
And that's what you want to prepare for.
Yes, and I think that generally speaking, when you get multicultural, you can also be multidisciplinary. But generally, I think people make more money if they're very narrowly specialized, like the proctologist, and that it's much harder to make a lot of money for most people if you try and imitate Warren and me.
I'm glad I didn't meet him earlier. I mean, okay, Andrew.
Okay, this question comes from someone who says, I am a Berkshire employee and shareholder. I read an investigative article from ProPublica on the Washington Post that many of Berkshire's various units only offer 401k plans with high fees that are actively managed rather than the low-cost indexes you have advocated as the best path for savings for retirement. The article's author said he contacted the company and nobody would comment. Will you do something to improve our 401k offerings to match your investment philosophy? And from an operational perspective, how did this happen, given your strong views on the topic?
Well, I've absolutely said what many, many times through annual reports, and our managers know what I think about the attractiveness of having an index fund option, but they all have different plans, different histories, and they run their businesses. And who knows, which particular, if you go back to the older businesses, they have defined benefit pension plans generally. Nobody puts them in anymore. Then the question is, do you transition to something else? In the end, we overwhelmingly let our managers make those kind of decisions and others. And my guess is that a very high, significant percentage of people who work at a company that has a 401k plan will have an index fund option, but they may not in some cases. The only thing I think we have asked the companies to have a limit on the percentage I think that they might put in Berkshire's stock through the 401k. We don't want people whose jobs are tied to Berkshire to. We certainly don't want to be in the position of encouraging them to put 100% or something of their savings in Berkshire itself. I don't want to be in that position. But I don't think even there we've insisted on any company doing that. I think we've probably made that when we've been asked about it once or twice. I think we've given that suggestion. But the managers who run the companies, the employees, if they feel, and some of our companies have human relations departments, if they feel that they'd like different options or something like that, they should make those views known to the managers. In some cases, the managers, I think, will pay attention to them, and others they probably won't. We've got a wide variety of managers that run our businesses, and we're not going to start trying to run them from Omaha. Charlie?
Well, I think you're right. That has happened, that business of the high fee choices, because we've delegated the whole subject to the managers of the subsidiaries. And so no attention at all is being given to the employee choices at headquarters. And what you're pointing out is that a lot of the employees in the subsidiaries would do better if they indexed instead of choosing what they did choose. And my guess is you're absolutely right about that.
Yeah.
And if there are any people, managers in the business today, I hope we'll do a little better at encouraging better choices.
Yeah, although we wouldn't want them, we don't want them to interfere too much in directing what they people. It's we could take over human relations.
No, it's up to the managers,
Yeah.
but we wouldn't object to a little different viewpoint.
And we have made it very clear what we think. I mean, they just, some of them don't listen to us. Okay, Greg.
Warren, you've noted time and again that there is a strong common culture shared across Berkshire subsidiaries, built on a commitment to honesty and integrity, a focus on the long term, and an emphasis on customer care. And that it's also critical to find cultures that mesh well with Berkshire's when acquiring operating companies. In most cases, the managers that are currently running these subsidiaries are the same individuals or members of the families that originally sold their firms to Berkshire, leaving them with a vested interest in the businesses they are running and a strong connection to the culture they tend to share in common with Berkshire. It seems to me that the greater challenge is in ensuring that the large publicly traded firms that have been acquired and account for a meaningful and growing amount of Berkshire's overall value stay the course. Could you comment on whether or not this is the case and what the greatest challenge is for you and Charlie when it comes to not only maintaining Berkshire's culture, but in finding firms that would fit in well with what you've built?
Yeah, I think the culture is very, very strong. And I think it gets reinforced. Frankly, I think it gets reinforced by the shareholders we have. I mean, we have a different body of shareholders, and we look at those shareholders, I think, in a somewhat different way than a good many other companies do. I mean, I think there are a fair number of public companies that wish they didn't have public shareholders. We're happy to have public shareholders. And we like having individual shareholders, and we don't favor institutions, and we're not going to give guidance and talk especially to them on investor calls and all that sort of thing. But we want it to be directly with we want shareholders who are partners, basically. And that begins with that. It goes to the directors. We have directors who are not, well, I've been on 19 boards, and I've never seen another board like ours. And I think it's terrific that we've got the people who represent, in many cases, lots of shares themselves. They didn't get special deals. It's a group of owner-oriented, Berkshire-conscious, business-savvy owners, and we don't have anybody on the board because they're a leading, educator or whatever it may be. We want people who basically think about how to run a business well for themselves and for their partners. And we've got managers who fit into that culture or who have chosen that culture in coming with us. And sometimes we have the second or the third or fourth generation, and say at the Nebraska Furniture Mart, that share that. Is it perfect? No, it's far from perfect. I mean, you don't get everybody thinking the same way. We have people that are very independently minded, running a lot of businesses, and some of them have different political beliefs. They see through different lenses than we do to some degree. But in terms of having a common, strong, positive culture, I don't think there's any big public company that has it any better than Berkshire. And I think that will continue because people opt into it to a great deal. Cultures get passed along. You do things that are consistent with the culture. So you do what you talk about is what you do, and you don't find people saying, we're a wonderful partnership, and then voting themselves, huge options, and a whole bunch of other people will say options beneath them because they can't look like they're taking it all for themselves and arranging. I read about some deal where it could pay off with many, many, many billions of dollars the other day. We won't name names. But we've got as good a culture as you can get. And I would say net, it grows stronger. We have a few people all of the time that really don't buy into it entirely. I mean, it is not 100%, but it's as close to it. And I think it gets closer all the time as we go along. And we will try to keep behaving in a way that reinforces it and doesn't dilute it. And I think that will not only work for Charlie and me, but it'll work for our successors very well. It won't be perfect. It won't be perfect. Charlie?
Every time I come to one of these meetings and sit in the manager's luncheon, I feel more strongly at the end of the luncheon that the culture and values of Berkshire Hathaway will go on and on for a long time after the present management is gone. In fact, I think it'll go on after all of the present managers are gone. I think we've started something here that will work well enough that it will last. And one of the reasons it will last is it's not that damned easy to duplicate. So the one that is present is likely to just keep going and going. Think of how little direct copying of the Berkshire system there's been.
But it won't produce the returns it's produced in the past either.
No, I think it's going to. I think it's going to last a long time. For a very simple reason. It's going to deserve to last a long time.
It works.
And it's going to work.
Okay. Station 4.
My name is Christian Marx. I'm a proud shareholder from Cologne, Germany. It is my pleasure to be here. My question relates to the Berkshire insurance operations. When I look at the quarterly balance sheets of the last 2 decades, I noticed a pattern that I kindly ask you to discuss. The sum of cash plus fixed income always hovers around 100% of the amount of insurance float. Therefore, my question is it fair to say that from the 128 billion of consolidated cash plus fixed income as of March, 116 billion are actually needed to support the insurance operations?
No, I appreciate you.
The answer is no, yes.
Yeah, the answer is no. But he deserves an explanation of how this, maybe I haven't looked at it the way he's looked at it. But we have we would much rather have a number closer to 20 than to have 116, and we do not correlate or in effect measure the float and then decide how much to put in or leave in cash and fixed income. It's the fact our float keeps growing, and lately our which is by design and has been terrific for us, and our cash and cash equivalents has grown because the competition for acquisitions has become much stronger as both as money is piled up in with the buyers of businesses and because debt has been so cheap and a variety of factors. But I don't think those are necessarily permanent. In fact, I'd be reasonably sure they aren't permanent. It's just a question of when they change. We are not tying, as Charlie said, we're not tying the cash and cash equivalents at all the float. The float has surprised me. The float went up $2 billion in the first quarter, and there is no way that float can shrink a lot in any short period. It structurally has been set up in such a way that it cannot shrink. And actually, I think it'll grow a little bit for a while. I mean, I've always been amazed by how much it has grown. We've got so much more float than any property casualty company in the world, and it's pretty amazing that it all came from that little building that Jack Ringwalt built and picked the location because it was near the tennis courts. Okay, Carol?
Well,
Charlie.
there are encouraging recent developments. Some of the cash has gone out recently for securities we vastly prefer over the cash. And we have a lot of cash that could be remaining that could be deployed in securities we might like a lot better than Treasury notes. So stay tuned.
Yeah, to make it very simple, in the first quarter we earned from operations we earned a little over $5 billion. Now we only spent about our depreciation. Normally we would spend somewhat more than that, but that's 5 and a fraction billion. $2 billion came in net from float, so that's $7 billion that basically in the first quarter that would have been added to our cash if we hadn't done something with it, and instead our cash and equivalents went down because we net invested more in equities by some margin than the 7 that came in. But we do have this position where even absent a change in float, about $400 million comes into Berkshire every week, which is very comfortable. And we want to get it so that more than $400 million is going out into productive assets, and we succeeded in doing that in the first quarter. So net we improved our position in the first quarter. Carol?
In your 1999 article in Fortune magazine, you said your belief that after-tax corporate profits were unlikely to hold much above 6% for any sustained period, due not only to competition but also to public policy. You stated in the article, if corporate investors in aggregate are going to eat an ever-growing portion of the economic pie, some other group will have to settle for a smaller portion. That would justifiably raise political problems. Since 2008, after-tax corporate profits have been 8 to 10% of GDP. Do you believe that is a permanent shift in the U.S. economy? And of course, we have to think about the latest tax bill. Or will corporate profits revert back to the 4% to 6% of GDP range that was normal in the 20th century?
Well, it's been an interesting development during that period. It goes back a little bit before that period, but you now have the four largest companies by market value in the United States, a $30 trillion market. You have four companies that essentially don't need any net tangible assets. And if you go back many years, I mean, if you looked at the largest companies, Carol used to put out the Fortune 500 list, and it would be AT&T or General Motors, and it was companies that, ExxonMobil, it was companies that just required lots of capital in order to produce earnings. So American industry has gotten incredibly more profitable in aggregate in the last 20 or 30 years. You look at the return on the S&P 500, the earnings as a percent of net tangible assets, and the rest is just, if you buy a company that has $1 million worth of net worth and you pay $1 billion for it, it still only had the $1 million of net worth. I mean, you just paid more for it. So the basic profitability of the company is huge, even though your investment may be at a significantly higher price. And so that what has happened is that I think if you look at the earnings on tangible net worth of the S&P 500 and compare it to 20 years ago, it is amazing. And that is really due to the fact that this has become somewhat, you could call it an asset-light economy. And those four companies that earn 10% of the they comprise close to 10% of the market value of the entire publicly traded corporate America. They don't take any money, basically, and that is a changing world, and they will earn even more money with the tax rate going down, and I don't think people have quite processed all that information in terms of what has gone on in the market. Carnegie built a steel mill and then he paid it off, or he borrowed a little money and then he built another steel mill and all of that sort of thing. But it was enormously capital intensive. And one industry after another, AT&T was enormously capital intensive. And now the money is in the asset light. I mean, huge money is in the not only asset light business, but the negative asset. IBM it has no tangible, there's a net minus tangible net worth. There's nothing wrong with that. It's terrific. But it is not the world we lived in 30 years ago. And in that sense, I didn't see that coming in 1999 when I wrote whatever I wrote there. It hasn't changed the profitability of the asset-heavy companies particularly. I mean, it isn't like oil. If you take the 5 most capital-intensive industries in the 90s, I don't think you'll find that their earnings on tangible assets have increased a lot. But you will find that this group has moved in that really doesn't. They don't need any net tangible assets at all, or they need very minor amounts. Charlie?
There's also a lot of financial engineering that's raised leverage, even in the capital-intense businesses. And, while Warren may have predicted a little wrong, when he wrote that very scholarly article. He didn't invest wrong. And so it just shows it's hard to make these economic predictions.
Okay,
You
John.
weren't very right on that one, Warren.
Yeah, actually, the performance of the stock market since then has been pretty accurate.
Yes, but that's true.
Yeah, being right for the wrong reason or something, or wrong for the right reason. Anyway, Jonathan.
Berkshire received a $10.2 billion retroactive premium from AIG early last year. If the upperly revised estimate of $18.2 billion of ultimate claims proves to be correct, will the cost of float, adjusted for favorable tax attributes, likely be lower or higher than what Berkshire would have paid to borrow $10 billion for a similar duration?
Well, we certainly go in with the idea that the cost will be lower. And it's an interesting situation. Essentially AIG, which is one of the largest property casualty, particularly commercial property casualty companies in the world, said, we want to give you all of the losses that we incurred in a very big percentage of our domestic business before December 31st of 2015, and we will pay the first $25 billion, and then after we pay $25 billion, AIG pays $25 billion, then you pay 80% of the next $25 billion. And they gave us $10 billion for doing that. And that's, if we are correct about our estimates of how much money will be paid and when it will be paid, we should come out being better off than if we had borrowed a similar amount. We have a history of doing 10 or so, maybe 12 big deals like that. We hold the record. We did it for Lloyd's of London 10 or more years ago, and we did it now with AIG. And sometimes we've been on the low side in our estimate, and sometimes we've been on the high side so far. AIG just said that I think they paid 15 and a fraction billion on these pre-12/31/2015 losses. They paid 15 and a fraction billion, but the payment tend to trickle down over years as you get further away from when the losses occurred. So I would say that we still feel okay about it, and we'll be wrong one way or the other. Everybody is when you estimate losses that may not get settled for 20 or 30 years. But so far on the group as a whole of these deals we've done, we've been okay. And I think on the AIG thing, we think we'll be okay. And I think AIG thinks we'll be okay. I mean, they entered into it for good reasons of their own. So it looks okay. Sorry to get into this technical stuff, but Jonathan always asks me questions like that, so I have to be ready to, I want to answer them. Okay, station 5.
Good afternoon. My name is Adam Bergman with Sterling Capital in Virginia Beach, Virginia. My daughter Michelle from Cape Henry Collegiate in Virginia Beach. Our question for you is how you go about attempting to forecast the degree of future success of one specific product in a good business versus another, such that you invest in American Express and Coca-Cola rather than Diners Club or RC Cola, for example. Thanks.
Well, with American Express, it was an interesting situation because Diners Club got there first. I think American Express, in a certain sense, I mean, they did it for a lot of reasons, but they went into the credit card business because they were worried about what was going to happen to traveler's checks. And although traveler's checks are still exist in a significant way, but the interesting thing when American Express went into competition with Diners Club and with Carte Blanche, as I remember that was also existed at the time was that instead of charging less than Diners Club and going in figuring they were going against an established guy and they'd come in at a lower price, they went in at a higher price, as I remember. And the American Express Centurion was on that card. I've got one that I got in 1964, but they were in it before that. It had more value in time. I mean, it got better representation. And frankly, if you were a salesperson out with somebody and you could pull out that American Express card with that Centurion, you look like it were J.P. Morgan. And if you pull out the Diners Club, it had a whole bunch of flashy signals. You look like a guy that was kiting his checks from one month to the next. And a fellow named Ralph Schneider and Al Bloomingdale developed the Diners Club, and they were very smart about getting there first, but they weren't smart about how they merchandised it subsequently. R.C. Cola, you know, it did. There are all kinds of colas that came after Coke. I mean, you know, you go back to 1886 and come up with something at Jacob's Pharmacy that's incredibly successful. You know, fairly soon you're going to get lots of imitators, but Coke really is the real thing. And you know, you offer me RC Cola and say I'll give it to you at half the price of Coca-Cola in terms of drinking it. I mean, this is a product that's 6.5 ounces, sold for a nickel in 1900. You know, and now if you buy it on the weekend and buy it in large quantities and everything, you're not paying that much more. This newspaper was 3 cents in 1942. You know, the amount of enjoyment per real, in terms of the real of what you pay for this, has gone dramatically down in inflation-adjusted money. So it is a bargain product. You know, you have to look at See's Candy. You know, if you live in California and you were a teenage boy and you went to your girlfriend's house and you gave the box of candy to her or her mother or father and she kissed you, you know, you lose price sensitivity at that point. No? That's so we really want products where people feel like kissing you, you know, rather than slapping you. It's an interesting thing. I mean, you know, in effect, we're betting on the ecosystem of Apple products, but led by the iPhone, and I see characteristics in that make me think that it's extraordinary. But I may be wrong. And you know, so far, I would say we've been right on American Express and Coca-Cola. American Express had this huge salad oil scandal in 1960, happened in 63, November, right around the time Kennedy was shot. And there was really worry about what the company would survive, but nobody quit using the card. Nobody quit using the traveler's checks. And they charged a premium price for their traveler's checks. So there are things you can see around consumer products that sometimes can give you a pretty good insight into the future, and then sometimes we make mistakes. Charlie?
I got nothing to add, except that if we'd been offered a chance to go into Coca-Cola right after it was invented, we probably would have said no.
We'd have turned to them. Yeah.
It would have looked kind of silly to us.
Well, unless we drank it now, Charlie, listen. No, he's right. I mean, we don't foresee things that we haven't got a lot of evidence in on. I mean,
No.
we want to see a lot of, if we're talking about a consumer product, we want to see how a consumer product behaves under a lot of different circumstances. And then we want to use something, actually, there was a book by Phil Fisher written around 1960 called Common Stocks and Uncommon Profits. It's one of the great books on investing. And it talks about the scuttlebutt method of investing, which was quite a ways from what Ben Graham taught me in terms of figures. But it's a very, very good book. And you can learn a lot, you know, just by going out and using some shoe leather. Now they call them channel checks now or something like that. But you can get a feel for some products, and then there are others you can't. And then sometimes you're wrong, but it is a good technique. It's an important investing technique, I would say that. And Ted and Todd do a lot of that. And they have some people that help them out on doing it too. Charlie's done it with Costco. I mean, he is. I mean, all the time he is finding new virtues in Costco. And he's right, incidentally. I mean, Costco has an enormous appeal to its constituency. They surprise and delight their customers, and there is nothing like that in business. You have delighted customers, you're a long way home. Okay, Becky.
This comes from John Hegarty at Bright Star Capital Partners, who writes, Warren, you're stepping down from the Kraft Heinz board at a time when the company is looking to do a large acquisition, Unilever, for example. Do you fundamentally disagree with the combative nature of hostile bids, activist investing, and competitive proxy contests?
Well, we will not make hostile tenders ourselves. I do not believe that there's anything fundamentally wrong with the idea. I mean, if you take the Fortune 500 companies, I'm sure that all 500 are not managed by the best, or in some cases even the friendliest to investor and managements in the world. So I don't think it's evil or anything to conduct a hostile offer for a company. It's just we won't do it, and we don't want to get into that. We like being liked by the managements that we join because we're counting on them to run the company, and we're not bringing in a whole bunch of people that know how to change businesses. We seldom take a position opposite to management, very seldom, on anything involving a proxy contest of sorts. But we don't rule it out. We don't think every management is entitled to be, that they don't have a lifetime hold on their business. But it's not our style at all well, we won't do it in terms of initiating it ourselves, and we'd be very, very, very unlikely to support the contest. But we have voted against a couple of propositions over 50 years that managements have had made in relation to stock options. We withheld a vote at Coca-Cola a few years ago to express our opinion. But we don't think it's evil for the shareholders, in some cases, to have different opinions about who should run the company or whether compensation is appropriate or matters of that sort. The stockholders still own the company. Charlie?
I've got nothing to add to that. I don't envy these people that are in these unfriendly uproars all the time. Imagine doing that after you were already rich. It's insane.
Yeah, we are definitely not looking for it. There are certainly companies that deserve challenge. I mean, and they propose things that deserve challenge occasionally. But again, it's not our main activity. And the question was asked in reference to Kraft Heinz. The people at 3G are great managers. They've been wonderful partners. I had made a determination before we got involved there. I was going to be on no more public boards. I'd been on 19 of them, and it takes a lot of time. And they asked me if I'd go on for a while, and I did. But it really is like 7.5 days or something. And if you're on a bank board, it may be quite a bit more than that. I mean, they're just being on a public board usually means quarterly meetings plus maybe an extra one. And at 87, I think I've now learned what happens, and it's fine, but I don't want to spend 7.5 days a year when I'm maybe I can call up people that I trust and admire who are on the board in 5 minutes, we find out what's going on or whatever it may be, any questions that come up. And so we are their partners and delighted to be their partners. And now we have 2 people on the board of Kraft Heinz, and they can do the traveling and I can stay home. Charlie, how many public, you're on Costco, of course, but over your lifetime, how many public boards?
Well, Costco, except for something like the
Pound?
Daily Journal where I own part of it, Costco is the only public board.
You were on Kansas
There wasn't
Power.
Berkshire or something I own personally.
Yeah.
I was on Kansas City Power and Light. Boy, that goes way back. But basically, it hasn't happened. I don't envy people who float around to a lot of different board meetings.
No, generally speaking, you have very little influence and spend a lot of time. And the trouble is, if you're going to a board meeting, particularly if you get to be international, and sometimes they feel they have to have one that's international, they feel they have to take up a fair amount of your time, or it wouldn't have been worth coming, thousands of miles for it. So you get a lot of this show and tell stuff, and that I find my mind drifting. Okay, Gary.
Yes, you've said that you are looking for non-insurance large acquisitions to put that cash to work. You've said that. I've usually thought of the United States because you're a big fan of the U.S. business. And I just was wondering whether you're seeing more opportunities as the rest of the world opens up, grows, whether there's opportunities for some of those mega transactions in other parts of the world, say Asia or Europe.
Yeah, Gary, I would say that I've been disappointed in that because we do see some outside the United States, and thank heavens we saw the one we saw in Israel some years ago when Eitan wrote me a letter. And we bought a business which is a very important part of Berkshire now. But we are still not. They're certainly aware of Berkshire Hathaway outside the United States, but they don't sort of pick up the phone automatically. In the United States, I think any large, particularly private company that is thinking about doing something, they at least think about Berkshire. But that in Europe or Asia, that we are not embedded in the minds the same way. They know about us. They know we got a lot of money, and they know we like to buy things. But we have really. We're on the radar screen big time in the United States, and we're not on the radar screen big time in the United States, and we don't, the immediate desire to be sure that they've thought about the Berkshire option does not occur the same way outside the United States. And we've tried to encourage it a few ways, but I would say that the results have not been great at all. But I hope tomorrow, I get a call from Germany or Britain or Italy or you name it, and Australia, wherever it may be, and I hope I get a call and we get an opportunity to do it. There's a good many countries we'd be quite happy to put substantial money into it. And like I say, our experience in Israel has been just terrific. Charlie?
Yeah, but the corporate acquisition game now is so driven by the leveraged buyout and the so-called what do they call them? Strategic, yes, strategic. I usually translate that into barnyard language, and there's so much craziness in price from our viewpoint. Of course, it's very hard for us to do it. The people in the leveraged buyout game who love massive leverage and don't mind high prices, even they are getting nosebleeds. It's hard, and it's not an environment that means that allows Berkshire just to go out and buy a whole lot of companies.
Have we ever made a strategic deal that
we have to wait?
We made a strategic deal that you can remember? Have we ever made a deal that we would have regarded as strategic?
We never had a strategic plan unless you've hidden it from me.
Okay, that answers that. Station 6.
Hi, I'm Brady Ritchie from St. Louis, Missouri, shareholder since 1996.
Terrific.
Warren, you and Charlie have been critical of business schools in the past and what they teach. With respect to value investing and super investors of Graham and Doddsville, you featured the returns of many great investors with different backgrounds, work, and education, with the lesson being following the philosophy is the key. To be successful today, does it still just fall back to Chapter 8 of The Intelligent Investor? And what do you think of programs and designations such as CFA, CFP, etc., which purport high standards, yet rooted heavily into academia? And I'd like to challenge you to a round of bridge tomorrow.
What was the last part?
What do we think about
Yeah, business schools and all that.
the business schools and all that?
Yeah. I didn't catch the last one.
They're better.
Oh, he's challenging me to a round of bridge. Okay. I went to 3 business schools, and at each, I found a teacher or two. I went to one specifically to get a given teacher, but at each one of them I found a teacher or two that I really got a lot out of. So we're not anti-business school here at all. We do think that the priesthood, say 30 years ago, for example, in terms of, or 40 years ago, in terms of efficient market theory and everything, they strayed pretty far, in our view, from the reality of investing. And I would rather have a person, if I could hire somebody among the top 5 graduates of number 1, 2, or 3 of the business schools, and my choice was somebody that was bright, but had Chapter 8 of The Intelligent Investor. Absolutely, it just was natural to them. They had it in their bones, basically. I take the person from Chapter 8. This is not, what we do is not a complicated business. It's got to be a disciplined business, but it does not require a super high Q or anything of the sort. There are a few fundamentals that are incredibly important, and you do have to understand accounting, and it helps to get out and talk to consumers and start thinking like a consumer in many ways in certain industries and all of that. But it just doesn't require advanced learning. And I certainly, I didn't want to go to college, so I don't know whether I would have done better or worse if I'd just quit after high school, and read the books I read and all of that. I think that if you run into a few great teachers and they really change the way you see the world to some degree, you're lucky, and you can find them in academia, and you can find them in ordinary life. And I've been extraordinarily lucky in having great teachers, including Charlie. I mean, Charlie's been a wonderful teacher. And any place you can find somebody that gives you insights into things you didn't understand before, maybe makes you a better person than you would have been before, that's very lucky, and you want to make the most of it. If you can find it in academia, make the most of it, and if you can find it in the rest of your life, make the most of it. Charlie?
Well, when you found Ben Graham, he was unconventional, and he was very smart. And of course, that was very attractive to you. And then when you found out it worked and you could make a lot of money while you're sitting on your ass, of course, you were an instant convert. And so
it still appeals to me, actually. I mean,
But the world changed. Before he died, Ben Graham recognized that the exact way he sought undervalued companies wouldn't necessarily work for all times under all conditions. And that's certainly the way it worked for us. We gradually morphed into trying to buy the better companies when they were underpriced.